Hi everyone, welcome to this new session of CFA Level 2 Equity. Today we'll be starting with the last reading of equity, which is Private Company Valuation. Now, there are a few things I want to get right out of the way for this particular reading. Private Company Valuation, the reading has two different parts in it in terms of when you look at it from the curriculum, ebooks, and all of that. One is the things which are there, which are different from the rest of the equity that we have done. So we've done discounted dividend valuation, we've done free cash flow valuation, residual income valuation, multiples. All of those techniques are applicable for a private company valuation as it is. The different part is that at each process, at each step of the process, there might be a few differences between how a public company should be valued and how a private company should be valued. For these particular sessions, the focus is primarily going to be on the new details we have, which are only specific to private company valuation. So we won't be spending too much time in repeating the things we have already done. One more thing I want to clarify, when you refer to some institute books or any other study material, you will find a lot of comprehensive questions, 2-3 pages worth of questions. And 80% of those questions are just repeating the calculations that we've already done in the previous reading. So far as these sessions go, we will not be covering all of those comprehensive questions simply because it's just spending time on things that we have already covered in the previous sessions. That being said, I am not denying that we will not be doing any comprehensive questions. In fact, for equity and all the other topics that do have bigger questions that often, confuse the students or at times even scare them a little for the topic, there would be additional videos coming out where we just discuss those larger questions, where I would be helping you out with some large questions so that you no longer feel scared of them. Effectively, the concepts, all the concepts that are there, we have covered them in these sessions. But sometimes when you see a very big question which expects you to compile all of those concepts together in one go, and that time it becomes a little scary. The reason why I don't cover all of those questions here in the session is because the session length is supposed to be small, it's supposed to be concise. But that doesn't mean we are going to skip them entirely. Once the video sessions are done, we will be going over the detailed questions. So with all of that out of the way, let's start with private company valuation. And the first topic we have is introduction. And the introduction is primarily focusing on one simple element. What are the factors that differentiate a private company's valuation with how we value a public company? So we've already studied a lot of techniques, dividend, free cash flows, all of those. How are those techniques going to be used for private company valuation, but in a different manner, maybe in a different step? Maybe the calculations would be slightly different. What could be the reasons that cause that difference? That is the first introduction part we have. So your syllabus divides the factors that differentiate private company valuation from public company valuation in some of these parameters. Now, keep in mind, this is just a basic list. If there's anything else that you can justifiably add to it, it's all good. So there are two categories of factors. One is specific to the company. So basically specific to the business that is being done, the entire organization as such. And the second category is focusing on stock related factors, which means sometimes the shares of a private company and shares of a public company, if I assume both the companies are on the same operation level, everything is same. Just the fact that one is a share of a private company and the other is a share of a public company, that could also have certain differences. That is stock specific factors. So starting with company specific factors, we have state of operations, specifically where exactly is the company in terms of its life cycle. Every company has a cycle. There's an initial phase, then there is an expansion phase, a growth phase, stability phase. And maybe if the industry is not doing well or industry is in decline, there could even be a decline phase for the company. It is very important to understand where exactly in that entire cycle is my company operating. If you think logically, you don't have startups with the IPOs. Only established companies tend to go for public listing of their shares. As such, most of the newer companies and smaller companies often end up staying private. So that is what this first part is saying, that there would be some differences between how mature a company is. Then you have the element of size. This is again related to the same thing, that mostly the bigger companies are the public companies and smaller companies are generally the private companies. And as such, valuation of both of them with exactly same techniques is not logical. So for that reason, there is a difference between how we should approach the valuation of a private company and that of a public company. Then management. Public companies normally have restrictions, both legal and otherwise, on what kind of management they are supposed to have. For example, board of directors, the number of board of directors and the different committees. Often larger public companies have a lot of restrictions that they have to have an audit committee, a risk committee. All of these are supposed to be there. And there is restriction on how exactly would the board rotation take place, all of those things. Private companies being smaller at times might get relaxation from some of those. So their management might not be as heavily governed by legal statutes as the case with public company. And then you have details of taxes. Smaller companies can often get some tax benefits. Specifically, government wants to incentivize startups and entrepreneurship. So what they do is they give some tax benefits, they give some low interest loans, something like that. So you would get those benefits. And lastly, financial information, specifically how much of it is to be disclosed. In case of public company, we have annual reports to be disclosed every year, quarterly reports to be filed, all of those. A lot of information is available for free in public domain, in most countries at least. It depends on regulations. But in general, private company information is not supposed to be in the public for free. It depends from country to country. For example, in India, a listed company would have its annual report available for free for you to access. But a private company is not going to offer you that same freedom. If you want financials of a private company, you do have access to them in India, but you have to purchase it from Ministry of Corporate Affairs. And whenever the filings are to be purchased from any sort of government regulator, most companies tend to file what is the bare minimum required legally. So often in the annual report, we get a lot of information, even more than what is legally mandatory. But private company would probably not go to that extent, and they will only give the information that is asked by the law. So not only is the access to information restricted, but also the amount of information might be low in case of private company. Then moving on, we have some factors which are specific to the idea that if I had two identical businesses, one had a private share and the other had a public listed share, there would be certain differences that appear primarily because of that. So first is, of course, the liquidity. A private company share is not having a ready market as compared to a listed share. So that could be one of the factors. Then you have marketability. Marketability is specifically talking about restriction on selling shares. A lot of times, if an investor comes in and buys a stake in the private company, he has to directly deal with the company. The agreement is between the investor and the company. And as such, those agreements can often contain clauses or provisions that restrict the investor from selling his shares without some sort of terms and conditions. So he is not able to readily sell as and when he wants. There might be some restrictions on those. So that affects the marketability of shares. And lastly, you have the element of control. Private companies mostly have owners who establish the companies and who are also part of the management. So often the control that someone can have for private company is going to be generally higher. As an investor, if I'm investing, let's say 10 lakh rupees, if I invest in a private company, I might get more share of control in comparison to me investing in a large listed public company. So I hope all of those factors give you a decent idea of why there are certain differences between private company valuation and public company valuation. Let's move on to the next portion.